Year-end tax planning webinar. My name is Vinay Navani. Before we get started, let's just talk about a few housekeeping matters to make the presentation go smoothly for everybody. There is a questions pane in the GoToWebinar dashboard, and use that to submit any questions or comments you have as we proceed to the presentation. We're either going to address them during the presentation or at the end, and if for some reason we can't get to them, we're going to have our contact information available at the end of the webinar. You can always email us your question if we weren't able to address it during the session. We're going to keep the presentation to 1 hour. Like I said, at the end of the presentation, there will be a slide with our presenters' contact information. There are going to be polling questions throughout the presentation. Some of you are signed up for continuing professional education credits. If you are, it is very important that you answer those polling questions. We cannot issue CPE credits unless you've answered all those polling questions. Doesn't matter whether you get the question right or wrong, just as long as you answer the question. There will also be a link for a survey sent to you afterwards. It's also part of the CPE process if you are taking this for CPE. And finally, if you have any comments about how to improve our programs or suggestions for future programs, please let us know that as well. Today our program is going to be focusing on providing business owners and individuals helpful tax planning tips that can be implemented before year end. We're also going to have a section at the very end about the new IRS Voluntary Classification Settlement Program. We're going to have three presenters today, Karen Schirmacher, Lauren Landolfi, and myself. Karen is a partner here at Wilkin and Guttenplan. She's got more than 20 years of public accounting experience. She's a tax professional with expertise in tax planning, research, compliance services, to closely help businesses, their owners, in a variety of industries, including real estate, manufacturing, restaurants, and professional service firms. Her experience also includes assisting clients with tax audits, as well as analyzing tax aspects of acquisitions and dispositions of business interests. Lauren is a supervisor at Wilkin and Guttenplan. Her clients include closely held businesses, not-for-profit organizations, real estate entities, and professional athletes. She assists these clients with tax planning and compliance services, as well as providing estate and trust services. And as for me, I'm a partner here at Wilkin and Guttenplan. I spend a lot of time on emerging and established businesses in the high-tech and software areas, as well as closely held businesses and their owners. At this point, we're going to start the presentation. We have it broken into three pieces. Karen is going to start the presentation by talking about tax planning for individuals. I'm going to talk. Lauren is going to talk about tax planning for businesses, and I'm going to talk about the IRS Employee Classification Settlement Program at the end, and also I'll also be interjecting throughout the program just to add some comments along the way. So at this point, we'll start with Karen.
Hello, everybody. Okay. As Vinay said, I'm going to be speaking about tax planning for individuals, and while it can be a complex process, we've basically broken it down into we have three goals when we do tax planning. First goal is to stay out of jail. The second goal is to pay as little tax as possible, and the third goal is to pay taxes as late as possible. Traditional tax planning, based on the way that we've always done it, we've always tried to advise our clients to defer income, into a future tax year, which ties into the third goal, which would be pay taxes as late as possible, and to accelerate deductions into a current tax year, which would allow us to pay as little tax as possible. With the political, what's going on with in politics today and the tax law, we know that we're going to be seeing tax rate increases in the future. So our tax planning strategies have kind of changed. Now what we find we're advising our clients to do is accelerate income and defer our deductions. And this is because we know that starting next year, or at the end of 2012 rather, the tax rates are going to be going up. So we want to try and take advantage of the lower tax rates now. As I said, we know that beginning in 2013, all of the Bush tax cuts will expire. What else happens? We know that the ordinary income tax rate is going to increase from 35% up to almost 40%. What's ordinary income? We have items such as wages, interest, dividends, retirement plan distributions, income from partnership investments, and things like that, annuities, all get captured in the definition of ordinary income. So beginning in 2013, those items are going to be taxed at roughly 40%. Long-term capital gains currently are taxed at a favorable 15% rate. And as of right now, we know that that rate is scheduled to go up to 20%. Also in 2013, there's two new components of the tax law that's going to take effect. The first one is this new Medicare tax, which is 0.9% of wages and self-employment income. That tax is going to apply to married filing joint taxpayers who have combined wages in excess of $250,000. The way that this tax is going to be collected is an employer is going to be responsible for collecting that additional tax on wages that it pays to its employees in excess of $200,000. If your combined wages, you and your spouse are over $250,000, however, if neither of you makes more than $250,000, the employer will not be collecting that additional tax. Instead, you, when you file your tax return, will be you'll be required to pay it when you file your tax return. Like I said, the tax also applies to self-employed individuals in the same manner as it would apply to two, working individuals who get W-2s. So you would look at, earnings from self-employment, and to the extent that is in excess of $250,000 on a joint return, you will be subject to that additional 0.9% Medicare tax. Additionally, the last component is there's a 3.8% Medicare tax that's going to be assessed on investment income for those taxpayers whose AGI, or adjusted gross income, exceeds $250,000. Investment income includes items such as interest, dividend income, from investments, again, annuities, rent and royalty income, capital gains, and other passive income from partnership investments.
So, Karen, I know you're in the next slide or two, you're going to prognosticate a little bit about the future, but we all know that the way currently the way Congress is now, the easiest action is no action. And if there's no action, what you're seeing on the slide right on the screen right now is what's going to happen in 2013. So if there is no change, we still have another year of the current tax rates. So it may not be an issue that tax rates are going up on January 1st, 2012. There may be another year of the same tax environment, but you really want to be thinking of a 1 to 2 to 3 year horizon of moving into a higher tax rate environment.
So like Vinay just said, whether or not Congress chooses to do anything, is yet to be seen. Clearly they're trying to target, high income taxpayers, trying to raise revenue by assessing these additional taxes. During 2011, Congress formed this super committee, which was charged with the task of, making recommendations to reduce the deficit. And the super committee was given a deadline of November 23rd to, come back with, some proposal on how to, reduce the deficit. A lot of things were on the table. They're looking at all aspects of, deficit reduction spending, military spending, tax increases, so on and so forth. And, with less than 2 weeks away, we haven't heard anything really coming out of the super committee other than the Democrats that are on the committee are disagreeing with the Republicans. As early or as recently as this morning or late yesterday, the Republicans had actually put a proposal on the table recommending certain tax increases, and the Democrats shot it down. So, we have yet to see where or what comes out of that, within the next couple of weeks. All right. I'm going to move into a little more specific things that we, look at when we're doing tax planning for our clients here. Probably the one that affects the majority of the population these days is the alternative minimum tax. Basically, the AMT is a parallel tax system, and there's certain differences between doing a regular tax calculation and an AMT calculation. And just if you look at the slide that's up now, you see differences between the two columns. So what is this slide basically telling you? There's certain things that are, certain items of income that are taxable for AMT purposes that are not taxable for regular tax purposes. Certain deductions that are not allowed for AMT purposes that are allowed for regular tax purposes. And I'll get into what some of those deductions are. But real basic, high level, conceptual, looking at these two different tax systems, you can see that there has the potential to be a major difference between the AMT liabilities and the regular tax liabilities of the same taxpayer. Certain incomes of, items of income that are subject to the AMT that are not subject to regular tax are income that stems from incentive stock options. I haven't seen much of this lately. I think since the .com stuff kind of all crashed and everything, you haven't really seen a whole lot of incentive stock options.
And a lot of it is due to the AMT bite that prevents a lot of people from exercising ISOs.
Right. And basically, what that means is you can receive, an incentive stock option, and you don't pay any tax on that for regular tax purposes or you don't pay any ordinary tax on that, provided you meet certain requirements. However, for AMT purposes, you will pay tax on, a portion of that income upon receipt of that incentive stock option. Basically, the difference between the fair market value of the stock and what the exercise price of the option is. There's certain tax-exempt interest that is not subject to tax for regular tax purposes. However, it is subject to tax for AMT purposes, and that's basically private activity bonds and things like that. Deductions that are not allowed for AMT are state taxes, real estate taxes, is all taxes, home equity line interest, if it's not used for, to improve your residence, and certain business depreciation, which we're not going to talk too much about. I'll let Lauren's going to cover that more. But the home equity interest is something that pretty much has the potential to affect a lot of people. You're allowed to deduct home equity line interest up to $100,000 or interest on $100,000 of home equity line debt for regular tax purposes, regardless of what you use it for. You could borrow $100,000, go on a vacation around the world and deduct that interest for regular tax purposes. But for AMT purposes, you would have to add that deduction back. The only time that you can deduct home equity line interest is if you use it to improve, make improvements to your home.
Let me interject for a second. There's a lot of talk about a flat tax and what a flat tax will do. Well, in my opinion, we don't have a flat tax, but we have a flatter tax, and that's really AMT. You've got a broader tax base and really a flat rate of 26 or 28%. So when you're talking about year-end tax planning, one of the things you have to really understand is, do you expect to be subject to AMT? Because that will dictate a lot of the moves you make or don't make for year-end. So it's important to understand conceptually whether you think you're going to be subject to AMT or not, and that will show itself as we go through a few more of these slides.
And I was just going to say that, the fact that the impact of AMT is so widespread, it has actually changed the way that we do our tax planning. We can't always just save it till the end of the year anymore and try and make some quick tax saving moves like prepaying state taxes or prepaying real estate taxes. We have to do this on an ongoing basis throughout the year, and like Vinay said, factor into the mix the impact of the AMT. So it's, in my opinion, we're planning more for the AMT than we are, regular tax planning, and it becomes more strategic. Okay. All right, capital gains and losses. Again, knowing that the capital gains rate will likely increase from 15 to 20%, over the next 2 years. Again, we've kind of changed our way of thinking with regards to how we advise our clients, related to capital gain planning. The past few years, there haven't been, a lot of individuals sitting with, net unrealized capital gains. A lot of people have, sold off stocks at losses and are sitting with capital loss carry forwards. So, now again, with knowing that the tax rates or expecting tax rate increases, what we want to try and do, I guess, is we've always advised our clients to sell and take advantage of the low capital gains rates, which we're still, advising them to do. So I guess we're trying to decide, we're looking at what our clients' capital gain position is right now. Are they sitting with losses? Are they sitting with net realized capital gains? And at the end of the year, depending on what situation they're in, if they're sitting with realized capital gains, we would probably advise them to sell any stocks that they have that have unrealized losses to offset those gains. For those individuals that are listening that are New Jersey residents, it benefits you to do that as well, because New Jersey does not allow for loss carry forwards, unlike that we have at the federal level. Another thing that we will at times look at is, if there's a stock that one of our clients has that they like the position, you can sell the stock, recognize your loss to offset, any capital gains that you may have, and then you can rebuy that stock. But the wash sale rules will make you wait 31 days. And basically what this rule says is that if you sell a stock at a loss, you have to wait, like I said, 31 days before you can repurchase that stock. Otherwise, that loss is disallowed. So, any planning that you would do around that one security would be wasted if you don't wait the 31 days. And that's 31 days before you sell the stock, 31 days after. So it's really a 62-day waiting period for the one stock. Other planning ideas that we may do would be, going back to the wash sale rules. Sorry. If you have a security that has you're sitting on an unrealized gain, and again, you like the security, you can sell that stock now, recognize the gain, and you can rebuy that stock if you want to continue holding the security. So what does that do? It gives you a stepped-up basis, and you could reduce future capital gains if you expect that stock to continue to appreciate. So that may be something else that you would want to consider, knowing the environment right now is that we're expecting capital gain tax increases going forward. And that when you sell a stock with a gain, the wash sale rules, you don't have that 31-day waiting period. Vinay, were you going to say something?
I was actually going to, maybe I'll take over the next slide. I've got clients who are saying that, I would rather, I've got a gain that I've locked in, it was a good investment, I sold it. I'd rather pay the 15% now and hold on to my losers that I haven't sold and hope one of two things happens. Either they don't become losers anymore and they go up in value, or I'm going to realize those losses in a future year when the benefit is going to be greater when my long-term capital gains rate is higher than 15%. So that's kind of the contrarian view that we've outlined in this slide.
Right. Okay. All right, on to IRAs. 2011 contribution limits are $5,000 per person. If you happen to be over 50, you get to make an additional $1,000 contribution, raising your limit to $6,000. The ability to make a contribution depends on whether or not you have earned income. So in order for you to make a contribution to an IRA, you have to have earned income, meaning wages, self-employment earnings, even alimony is considered earned income for purposes of making an IRA contribution. The contributions have to be made by April 15th, or technically the due date of your tax return. So when we look at our 2011 tax returns, the due date of those returns is April 15th, 2012. So individuals that want to and have the ability to make an IRA contribution have until that date to fund their contribution. There's three types of IRA accounts that we're going to discuss. A traditional IRA, traditional deductible IRA, traditional non-deductible IRA and a Roth IRA. There's also a STEP IRA, which is a self-employed retirement account, and we're not going to really get into that too much. With a traditional deductible IRA, individuals can make a contribution into that IRA account, and provided certain requirements are met, they get a tax deduction for that contribution now. The tax on that IRA gets paid when it's distributed, presumably after retirement or when you turn 70 and a half and you have to start taking the distributions out. The ability to get a deduction, a tax deduction for this IRA contribution depends upon a number of factors. One, what your AGI is, and that coupled with whether or not you are covered by another employer retirement plan. If you happen to work, you're a W-2 employee, and your employer sponsors a 401k plan that you participate in, your ability to get a deduction for a contribution to a traditional IRA will be limited. It likely will be limited, or at least phased out. So married filing joint, if you file married filing jointly and your AGI is over $110,000 and you're covered by an employer retirement plan, such as a 401k plan, you will not be able to take a deduction for your IRA contribution. The rules change a little bit if one spouse is covered by a plan and another spouse is not covered by a plan, then the income phase outs are a little different. So you really have to, I guess we have, during our tax planning process, we would look at different situations and analyze, what makes most sense. If neither spouse is covered by an employer retirement plan, a full deduction is allowed for contributions to a traditional IRA. One point that I want to emphasize here is, going back to the second bullet, what does covered by an employer retirement plan mean? If you were covered under a plan at any point in time during the year, it doesn't have to be for the whole year, it's not as of the end of the year, it could be for 2 weeks. You could potentially find yourself in a situation where your deduction for your IRA contribution is limited. So, when you get your W-2s at the end of the year, you'll see the little box that says retirement plan. If that's checked, we would be focusing in on that when we decide, whether or not we want to advise you to make an IRA contribution or not. Right, a traditional non-deductible IRA. It's another option if you want to put money into a retirement plan and have it grow tax deferred, and the tax deduction doesn't mean that much to you. You can always make a non-deductible IRA contribution, subject to the same limitations as a deductible IRA, meaning you have to have earned income in order to make a contribution. So if you have a W-2 with $3,000 of earnings on it and you're 55, you can only make a $3,000 IRA contribution. You can't put away more than your earned income. The difference between a non-deductible IRA and a deductible IRA basically deals with how the distributions from those accounts are taxed. A non-deductible IRA, you will not be taxed on 100% of your distribution because you didn't take a tax deduction for the amount of the contribution. So you have to keep track of the amount of money that you put in because you will always have the ability to recover your investment in that account tax-free. It's just the appreciation on the account that is subject to tax. So there's a form, the last bullet highlights Form 8606. That's the form that we would use to track those contributions to your non-deductible IRA account.
And let me just interject that it's really critical if you ever make a non-deductible IRA contribution to keep track of that, because you basically wasted the benefit of that after-tax contribution if 20, 30 years later when you start to take money out, you don't remember, you lose track of that after-tax earnings. So for our clients, if they ever file an 8606 with their return showing their non-deductible basis, we basically carry that forward as long as we're preparing that return, just because it's critical to keep track of that basis number.
The other thing that's important too is, again, certain states don't allow a deduction for an IRA contribution. So whether you put money into a deductible IRA or a non-deductible IRA, when that money comes out, and New Jersey, is one of those states, and I believe Pennsylvania is one of those. Pennsylvania has, rules like that as well. So we as accountants would want to know how much you put in, because again, that money that comes out, state tax free. So it's important that you, you keep those records so that you can help us properly determine, how much of those distributions is taxable. All right, Roth IRA. They've changed the rules, a little bit with who's eligible to contribute to a Roth IRA and who's not. The benefit of a Roth IRA is, one, you don't get any deduction now for contributions to it, but you pay no tax on any of the distribution when it's taken out in the future. So as opposed to a regular IRA account, which grows tax deferred, a Roth IRA grows tax free. Whether a Roth IRA versus a traditional IRA, is best really depends on the individual taxpayer circumstances, and there's a lot of planning, that would a lot of different scenarios that we would look at to determine what makes most sense for you from a tax standpoint. Again, there's AGI phase outs, which limit the ability of certain people, taxpayers to make contributions, and that phase out is for married filing joint taxpayers with income between $169,000 and $179,000. Above $179,000, you're not allowed to make a contribution to a Roth IRA, and like I said, the earnings are tax free. Okay. We've seen a lot of activity over the past couple of years related to individual, taxpayers converting a traditional IRA to a Roth IRA. The ability to do that used to be restricted to lower income taxpayers, but now they've lifted those income restrictions, and over the past year, at least I've seen a number of clients at least consider whether or not they want to convert their traditional IRA to a Roth IRA. So what's the benefit? Again, the benefit is that that account, upon conversion, will grow tax-free, and at some point in the future, you can take those distributions out and not pay any tax on them. The downside to that is that you have to pay tax on the value of that account upon conversion. So again, depending on whether it was a deductible or a non-deductible IRA account will determine how much, what the value is that gets taxed. There's a lot of flexibility here in that, with the way the market has been now, people have made the decision to convert, their IRA account to a Roth IRA and then realize, later on in the year the value of that account has dropped significantly. You actually have the ability to go back and reconvert so that you don't have to pay tax on a higher value when months later, the account is worth less than that. So again, it's something to consider. Again, especially since we're expecting tax rate increases, it might be something that we would want to look at in connection with year-end tax planning, whether or not we should convert, advise you to convert your account.
And just another point is that everything Karen just spoke about with IRAs is really focused on decisions that have been made by April 15th, except for the decision as to whether to convert or not. If you're going to convert, that's going to be done by December 31st, 2011, and if you're having a low-income year and or the value of your IRAs is low, this may be a great time to consider that.
And the other thing, if it's something that you've been considering, you want to give your brokers enough lead time where they can start processing paperwork. It really shouldn't wait until the end of the year. December 30th, you call your broker and say, oh, by the way, I want to convert, because I know there is, paperwork that has to get done, and, it makes more sense to make sure that the conversion gets done by, making the decision early in December. Okay. All right, estimated tax payments. Again, one of the goals of tax planning is to pay our taxes as late as possible, and one of the things that we try to do is put our clients in a position where they are not going to be subject to a penalty. IRS wants us to pay our taxes as we earn our income, so pretty much ratably throughout the year. And there's a couple of ways in which we as individuals pay our taxes. We either have them withheld from our pay, or we make estimated tax payments. Again, under the theory that we have to pay it in ratably throughout the year, withholding, comes out ratably as we earn our income, but estimated tax payments for those individuals that are self-employed or have other sources of income where there is no withholding kind of complicates, the calculation a little bit. There's a couple of exceptions to the penalty provisions. One, you can rely on your prior year tax when determining how much tax you have to pay in. So if you know your tax for this year is higher than what it was last year, all we really need to do is make sure that you have, enough tax paid in to cover your prior year tax liability. If you're in a position where your income is earned, not ratably throughout the year, you can, you're in a business where the majority of your income is earned in the fourth quarter. There's calculations that we can do to design your estimates, again, to avoid penalties based on how you earn your income. And if towards the end of the year that you're going to be short and possibly subject to a penalty, there's a couple of options that you have. One, if you have a retirement account, you can take a distribution from that retirement account and have the distribution applied towards withholding, and that would be treated as if it went in ratably throughout the year. And then you have 60 days to take that money and put it back into your retirement account to avoid any early withdrawal penalties. Okay, so there's a couple of things that we can do. Okay. Next slide is just different, the way that we look at the estimated tax penalty calculations when we do, our year-end planning. So I'm not going to really cover much on here. Okay.
And so now I think it's time for a polling question. Avery, can you put the polling question? Tax payments can be made in which of the following ways? Estimated tax payments. Looks like estimated is misspelled. I apologize. Withholding on wages. Withholding on retirement distributions. Oh, retirement's misspelled too. And or all of the above. So it doesn't matter whether the question's right or wrong, but especially if you're getting CPE credit, you need to answer one of the questions, so please respond. I see some of the responses coming in. We'll keep polls open for another few seconds. And people are still voting. Okay, almost there. Please hurry up and vote now so we can move on with the webinar. Okay, why don't we, it's been a minute, let's cut off the polling, and of course it's all the above. So moving on to the next topic, Karen.
Yep. Okay, I'm just going to spend a minute talking about casualty losses. Again, this is more of an East Coast thing, so if you're not on the East Coast, it may not affect you as much, but we've had some pretty crazy weather, and a lot of our clients have experienced different casualty losses. Depending upon the amount of the loss, the timing of it, what your income is, there is the ability to deduct these casualty losses for damage to your home, personal property. The amount of the loss is limited to either the cost of whatever was destroyed or the decrease in fair market value. From an actual, go to the next slide. This example here basically shows you very simplistically how we would determine the amount of a casualty loss. You have $10,000 of damage, your AGI is $80,000. The first step is you take the amount of the loss, which is $10,000, reduce it by 100, and then you can only deduct the casualty loss that's in excess of 10% of your income. So the way that the formula works in this example, this individual would be entitled to a $1,900 casualty loss deduction. When you're dealing with insurance, you have to reduce the amount of the deductible loss by any insurance reimbursement you receive. And at times, because these claims sometimes take a long time to finalize, you may not know whether or not or what the final amount of the reimbursement will be by the time you file your tax return. So you can estimate the amount, and then if you estimate too much or not enough, you can run the effect of that through on your subsequent year's tax return. This last slide is you claim these casualty losses on the your tax return for the year of the loss, unless you're in a federally declared disaster area, and then you can amend your prior year return to take the deduction. So we've seen some activity there. Okay, I'm going to move on to itemized deductions now and just talk about some of the things that we do when we're doing year-end tax planning surrounding itemized deductions. Medical expenses. We don't see many clients getting benefit, from deductible medical expenses because the threshold, for deducting them is relatively high. So your out-of-pocket medical expenses have to exceed 7.5% of your AGI before you even will get an itemized deduction. To the extent we have, lower income taxpayers that have high medical expenses, what we try and do is advise them, to bunch their deductions and, possibly hold off paying bills or maybe prepay bills, to try and increase the, the expenses in any given year to try and take some, get some benefit from the deduction. That last note, self-employed taxpayers do get 100% deduction for health insurance premiums, and that falls outside of the itemized deductions. That actually comes right off the top of your income. New Jersey, the threshold is a little lower, so a lot of times our client base is we have a lot of New Jersey clients. We do see individuals getting a state benefit for their medical deductions without getting a federal benefit. So we look at that. Items such as amounts deferred into a flex spending plan are eligible for deduction on New Jersey returns as well. All right, taxes. This is going to tie back into the discussion earlier on the AMT. Real estate taxes, New Jersey and other state income taxes are allowed as a deduction for federal purposes, again, in the regular tax calculation. Doesn't matter what year the taxes relate to. When we determine the deductible taxes, we look at the year that these taxes were paid. So if you receive a notice, for example, a tax notice assessing additional taxes for the 2009 year, and you make that payment in 2011, you would be entitled to deduct that payment in 2011. Same with real estate taxes. You can, defer or accelerate real estate taxes, into any given year, and the year of payment is what dictates, or the year that it's paid is what dictates when we deduct it. So, we used to, before AMT started affecting so many taxpayers, one of our tax planning strategies always used to be we would advise our clients to prepay their state taxes. And nowadays, do we advise them to do that? Probably not. It just doesn't make sense to do that.
And that's driven by AMT.
Correct. So again, just finishing up this discussion, state taxes are not deductible for AMT. So as part of our tax planning, we would do a projection to see whether or not, or how much we want to prepay, if anything. Okay. Right. Charitable contributions, a lot of individuals towards the end of the year, they'll make their charitable contributions. Some do it by cash. A lot of charities will accept credit card donations, and as long as you make that credit card charge by December 31st, you can deduct the contribution in 2011, even though you may not pay the bill until 2012. Recently, over the past few years, there have been a lot of substantiation rules, and we have to make sure that we meet all those substantiation rules. Gifts of securities, again, if appreciated, there's a lot of planning that can go involved. I'm going to kind of move through this stuff a little quickly. If the security is appreciated and you're sitting on a long-term gain, what you would want to do is transfer the security directly to the charity. You'll get a deduction for the fair market value. However, if the security has depreciated, the advice that, we would advise you to sell the security, recognize the capital loss, which you could possibly deduct, and then transfer the cash to the charity. So you would kind of get, a double deduction, if you will. Okay. This is the last year, these gifts from IRAs. Individuals that are over 70 and a half in a position to have to take these mandatory required distributions have a month and a half left to decide whether or not they want to make a direct transfer from their IRA to a charity. So what does this do? One, it satisfies the required minimum distribution, the required minimum distribution. You don't pay tax on it. It's not a charitable deduction, and you get to, I guess, satisfy your philanthropic, wishes, and it's good for those individuals that don't really need the IRA money but have to take it out. That's something that we've, we've looked at for clients. And again, this provision expires the end of this year. Another strategy that we see a lot too is have our clients put money into a donor-advised fund. So basically, you put a chunk of money into a donor-advised fund. You get a charitable deduction today for the amount of money that you put in, but that fund will distribute that money over future years to various charities that you decide. Why is this a good idea? If you have a very high income year and you're looking to find ways to reduce your income, this may be something that you want to consider. A lot of the brokers have set these up. They are cheaper to administer than a private foundation. And, like I said, you get an upfront tax deduction for the money that you put in, but can spread the contribution out over, a number of years. Miscellaneous itemized deductions, there's, a bunch of things that fall under this category. Tax prep fees, investment advice. Once you lump all of these together, in order to get any benefit, they have to exceed 2% of your adjusted gross income. So again, our strategy with regards to tax planning would be to bunch these deductions, in a current year or a future year to try and reach the threshold. The downside to items like this, they're not allowed under AMT. So, lately you don't see a lot of benefit from these. And real quick, for those of you that, are looking to make improvements on your house, there's still tax credit available for energy efficient investments. Insulation, windows, doors, the improvements have to meet IRS criteria, and they have to be installed by the end of this year. It's not a major credit, it's $500, and it's subject to reduction if you claim the credit in prior years.
You had me excited before you told me about the $500 limit, Karen.
Okay.
Very good. Thank you, Karen, for that update on individual tax planning. So now Lauren is going to talk through some developments and strategies to consider for businesses as we approach the end of the year.
All right. So first we're going to talk about some capital investment decisions that you can make. So we'd like to first go over what our typical treatment is. Typically, if you spend $100 on a fixed asset, so computers, furniture, any type of equipment, the asset will be depreciated over 5 to 7 years or longer based on IRS tables, essentially the life of the asset. So the business is out of the cash during the first year, but they get a benefit of that tax deduction over all future years. So the expense gets spread over the future tax years. Because of this economy we're currently in, Congress has been doing quite a bit of work trying to encourage people to spend money. And one of the big provisions that's been in place is bonus depreciation. And what bonus depreciation allows you to do is deduct 100% of the cost of new property in the year that it was placed in service. So right now we're looking at 100% bonus depreciation for our 2011 tax year. Now, to get into some details on this deduction, the property must be qualified. It's going to include items such as machinery and equipment, most computer software, certain types of leasehold improvements. The property must be placed in service by December 31st of this year. After this year, the 100% bonus depreciation is scheduled to go away and the deduction will be no longer available. Next, we'll go into a little more details on this bonus depreciation. Just ordering the equipment by December 31st doesn't count. This property needs to be in use and installed by December 31st of this year. Another item that must be met in order to take this deduction is the property must be new. Used equipment is not going to qualify for this type of deduction. And Going forward, assets placed in service in 2012 are right now scheduled to be eligible for 50% bonus depreciation. Because there's always movement in Congress trying to get this economy sparked, we could see some changes in this provision, but as of right now, 100% bonus depreciation is scheduled to expire at the end of this year, and going forward, we'll see 50% bonus depreciation for 2012.
All right, Lauren, let's do a polling question, make sure people are still awake. During 2011, what percentage of the cost of new property can you deduct? 50%, 100%, or 0%? So again, if you're getting this for CPE, please respond as quickly as you can so we can keep the webinar moving. And we'll keep it open for about 20 more seconds. And we've got 75% people who voted. Okay, just a few more seconds, we'll close off the voting. Okay, Avery, why don't we move on now? Okay, Lauren.
Okay, so another type of accelerated fixed asset expensing is going to be Section 179 expensing. And this is an alternative recovery than bonus depreciation. Like 100% bonus depreciation, it allows us for a current year full deduction of the capital expenditure during the current year. 179 does have more restrictions than bonus depreciation. The first is going to be an income or an expense limitation. So the maximum amount of Section 179 expense that you can get in 2011 is going to be $500,000. In 2012, that 179 limitation is going to go down to $125,000. So if you're considering making some large fixed asset purchases, you're going to want to make sure to make those purchases by the end of this year. The other, the good thing about Section 179 expense is that if you have purchased used equipment, you can take 179 expense on used equipment. So just some high-level discussion of why you would choose 179 or bonus or vice versa. It's going to depend on the assets. You're going to want to talk to your accountants about that. The one thing with Section 179 expense is you can't create or add to a net loss. So with bonus depreciation, you can create a loss and deduct that loss. You can carry back the loss or forward the loss with bonus. With Section 179 expense, if claiming that expense will give you a net loss position, the Section 179 expense needs to be carried forward, so that's not going to be an ideal situation. Bonus depreciation is going to be better than 179 as far as the expense limit, because we can take, there's no limitation on the amount of bonus depreciation that we can take, while there is a $500,000 limitation on the amount of Section 179 we can take. But then again, Section 179 is going to be better because we can take this expense if we purchase used property. So whether you need to take Section 179 expense or bonus depreciation expense is really going to depend on, very specific facts and circumstances.
But in any event, there's a lot of powerful incentives, no matter how you slice it, for businesses if they have capital equipment in their budget to be looking at trying to acquire it this year.
Okay, next we'll go into some business automobile purchase items. Business autos are always subject to severely limited depreciation deductions, so they don't typically follow the standard depreciation rules that we've just discussed. So regardless of what the vehicle costs, our expense, our depreciation expense, is going to be limited to $3,060 per year. This number is indexed for inflation, so this is right now what our 2011 expense is. Now, because we have bonus depreciation provisions currently in place, you can take bonus depreciation on a business auto, but you will not be able to deduct the full cost of the auto. You're going to be limited to $8,000 in the first year for that particular auto. Now, if you purchase a heavy SUV, so an SUV that has a gross vehicle weight of over 6,000 pounds, these limits that we just talked about on the last slide aren't going to apply, and you can take 100% bonus depreciation on that asset.
So, Lauren, if you told me before, Karen told me before, that if I buy an energy-efficient door, I can get a $500 tax credit, but if I buy an $80,000 Range Rover, I get an $80,000 deduction, right?
Correct.
Okay, I just wanted to clarify that.
So a couple more details about our business autos. The autos must be new in order to claim that 100% bonus depreciation. The deduction is $8,000 or 100% of the cost if less than $8,000. And these numbers are based on 100% business use. If you use this asset for less than 100% of business use, you need to prorate that deduction between your regular, personal use and your business use. And commuting is not considered business use. So your time traveling to and from your office, between your home does not count. But once you get to your office, if you're traveling to client sites, those miles will count, and those that business use will count. Now, Karen went over, a lot of the details with these business retirement plans. So I'm just going to highlight some quick items as far as business expenses go. There's a bunch of different types of plans out there. We're not going to go into detail. What these retirement plans allow you is a tax deduction today, and then we recognize the income when we retire. There is a discrimination concept, so you can't contribute only to the owners or highly compensated employees and not contribute to your lower grade employees. You need to contribute evenly for all your employees, or there will be limitations on the amount of contributions. And contributions can be made by the extended due date of the return. So right now we're in our 2011 calendar year. Our corporate tax returns are due March 15th if we're calendar year taxpayers. Those calendar year corporations will actually have until September 15th under extension provisions to make those contributions.
And just another note is some of the more flexible and dynamic plans do require that the plan be set up by the end of the year. It doesn't have to be funded until the dates Lauren just mentioned, but it is important that the plan get structured this year. So keep that in mind if this is something you're interested in.
Okay, and last, as far as the business tax planning goes, we're just going to talk quickly about some corporate dividends. Again, Karen mentioned that our corporate tax rates our long-term capital tax rates are at 15%, so very favorable rates. That will apply to corporation dividends. So through December 31st, 2012, dividends from your C corporations are going to be taxed at a 15% long-term capital gain rate. For closely held C corporations and certain S corporations, you might want to consider distributing out of earnings and profits now while we have these favorable tax rates in place, rather in future year when these long-term capital gains rates are going to be increasing. The other planning opportunity is we see a lot of clients that have loans on the books that in essence aren't technically loans or aren't looking like loans, and the chance that they're actually going to be repaid is very slim. If that's the case, you might want to distribute these loans out now and take advantage of these 15% tax rates while they're still in place before they expire. So last, Vinay is going to discuss our voluntary classification settlement program.
Okay, we're in the home stretch here. So the IRS just came out recently, within the last month, with this new program called the Voluntary Classification Settlement Program. Now, when a business hires a worker, and I'm going to use that term very loosely, that worker is going to generally wear one of two hats. Either they're going to be considered an employee of the business, or they're going to be considered an independent contractor to the business. Okay? And let's talk about what we would like. If I'm an employer, I generally want to look for an independent contractor relationship anywhere where I can make that work. And the reason is I, as an employer, don't have any payroll taxes. That person is really not considered to be an employee. They're not part of my calculation of the retirement plans. Lauren talked about that discrimination concept before. They don't enter into that discussion. Other fringe benefit plans they're not part of. They're issued a Form 1099 where we just tell the IRS how much we paid them. On the other hand, if they're an employee, the employer is going to be subject to employer-level payroll taxes, and that's going to include FICA of 6.2%, Medicare of 1.45%. The states will have their own unemployment and disability rules, as well as a whole host of state labor laws, overtime, paid time off, things like that. And that employee will get issued a Form W-2. So the IRS would like everybody to be employees, just in the same way businesses would like everybody to be independent contractors. And back in the late 80s, they issued a revenue ruling that listed 20 factors, and you hear them referred to a lot about the 20-factor test. And there's subjective tests that talk about, that really focus on what is the nature of that relationship. And a few of the things are who sets the hours, who decides where the work is performed, who pays for that worker's out-of-pocket expenses, who provides the tools or materials that worker needs. Does that worker have the possibility of making a profit other than just a straight hourly wage? Those are all these subjective factors that go into the determination of whether somebody is an employer or an independent contractor. But I look at it this way. If I hire an independent contractor, I'm concerned with their end product, not how that product is developed. If you hire Wilkin and Guttenplan to prepare a tax return, you want that end product, and that's really, you don't care how we as a firm produce that end product for you. If I hire an employee, I'm concerned about the end product, but I'm also concerned about how that work is done. So I'm just as concerned about the performance of the services as well as the end product. So in many industries, you know, IT is a great example. There has been a lot of controversy as to whether workers are independent contractors or employees. Oftentimes when you have relatively short engagements, projects you hire somebody for, there's a tendency to want to call them an independent contractor, whereas in reality, if you looked at these 20-factor tests, they'd really be employees. And the IRS has gone through lengthy audits when it examines these issues. And in the new approach, as part of this classification settlement program, they're really offering employers a fresh start. And what they're really saying is, if you have people that you've treated as independent contractors in the past that really should be employees, let's start treating them as employees prospectively. And we're going to really encourage you to come forward prospectively to treat them as employees. And we're going to do that. We are going to impose a penalty for the prior years, but it's an amazingly small penalty, okay? So some of the fine print is that we have the employer actually goes to the IRS to be part of this program. They have to seek relief for all their independent contractors or a particular class of independent contractors. You can't just pick and choose. I want Bob and Joe and Sally, who were previously considered independent contractors, to be part of this. I must have issued them 1099s. I must not be under audit by the IRS, Department of Labor, or a state tax or labor agency. And I have to agree to extend the statute of limitations for a few years so the IRS can check up on me and make sure that I'm still doing the right thing. So what does this cost? It really costs 10% of the total payroll taxes that were due for the prior 12 months, okay? So let me say that again. You look at the compensation that you paid the person for the prior tax year, you look at the payroll taxes that were due, and you pay 10% of that. And I didn't put this in the slides, but the payroll taxes that they refer to are actually, it's computed in a different way, and it's actually much less than you would have paid had you gone through and treated them as actual employees. So as a practical matter, you're paying about 1 to 2% of compensation for this class of workers that you're trying to recharacterize as a charge, okay? And there's really no separate other interest or penalties associated with this program. So clearly what the IRS is doing is they're trying to get prospective compliance into the taxing system. How do you do this? There's a form on the IRS website, Form 8952, which you apply to the program, and the IRS wants to receive that 60 days prior to the proposed change in status. So it's a great program for all employers to consider, that if you have independent contractors that there is some concern about their treatment. Other things to consider as part of that is you're going to bring all these employees into the system. What does that say about your retirement plans? You have to go back and recheck those discrimination tests we were talking about. And each state, I don't think any states that I've seen have really come out and weighed in on how they're going to treat this, the IRS program, whether they're going to impose penalties for back years or not. So if it's something you're interested in, we also have to look at the states that are impacted and try to make an educated decision as to what the best strategy is based on how we think the states are going to respond. So we are out of time. I hope you've gotten a lot out of this. We've certainly enjoyed being here. Oh, before I get too excited about wrapping up, we do have a last polling question. And okay, under the IRS Voluntary Classification Settlement Program, penalties and interest are charged. True or false? So last CPE question, please respond, and then we'll be wrapped up for the day. And almost everybody's voted. Just another 10 or 20 seconds. We'll keep the polls open. Okay, why don't we go ahead and stop the polls. This is our contact information. Oh, there's the answers. Okay, and here's our contact information. Please feel free to email or call any of us if you have any specific questions. We hope you've enjoyed today's webinar. Thank you.